gold does or have been doing for a long while what a Bitcoin wants to do for the future. We say India is moving from a country of savers to a country of investors. And it's got very strong linkage with per capita. If your incomes are lower, what happens is your expenses are fixed. In India, we know it is child education, marriage, etc. You have to save. If rates go down, you save more. As an economy, as a business, hunt for places which are hitting teens.
In its prime, about to hit prime.
Yes. So the longevity of growth that India offers, nobody else does.
Yeah.
But think of India as your last sustained growth destination.
The most underrated skill, according to you, for a successful fund manager?
Time to sell.
Time to sell.
Very important.
I agree. Hi, welcome to First Talk. I am Vikas Sharma, and today we have a very special guest with us, Prateek Agrawal, Managing Director and CEO of Motilal Oswal Asset Management. Prateek has spent over 2 decades navigating India's capital markets and building one of country's leading asset management businesses. In today's conversation, we'll talk about India's remarkable growth story, the big investment themes shaping our future, and the changing face of the AMC industry. Welcome to First Talk podcast, Prateek.
Thank you.
So, Prateek, today we're going to talk about India's alpha mindset. I've always believed that Indians are constantly looking for alpha generation in their portfolio. The reason I believe active fund management share vis-a-vis passive funds in India is so skewed. The reason for that is that somewhere we are an investor community that is seeking alpha very quietly and privately. We're going to discuss and deep dive on what is the reason behind that mindset and is it really a sustainable mindset. India's market cap to GDP ratio, Prateek, has recently in the last few months crossed 130%, as you're aware. The last time it crossed that number was in 2007. And we know what happened in 2007, right? So what I want to know from you is that this time around, do you think it's structural re-rating that's on the cards, or do you think it's another instance of stretched valuations, similar to other instances in the past?
No, so this is an indicator. I tend to believe less in it. See, just think of it. There is another news item which happened some time back, which says just about 50% of the businesses in India is represented on the markets.
Yeah.
If we correct for that, then actually market cap to GDP is 2.6. It's not 1.3. And in the same context, if you then look at a country which is just starting to emerge, very small part of it would be represented in the market, and by using this same indicator, you will say it is cheap. So this indicator may indicate something in developed large markets where a lot of what has to happen has happened. It works less by virtue of what I suggested in emerging economies. Second, this indicator assumes constant margins across the world.
Yeah.
Now, margins in a hyper-competitive country may be very different from a margin in a less competitive country.
Yeah.
If margins of businesses in India, the ROCEs of businesses in India are higher than elsewhere, and ROCEs are higher than elsewhere, then valuations that a business would command in India would be higher than elsewhere, and it shall sustain if you expect ROCEs and growth to sustain.
Yeah.
So it's a combo of a few factors. I think in the current context, I would believe we are nicely positioned for an upside rather than staring at a cliff for a downside. The fall in 2007 happened not because we reached 130% of
We
GDP.
reached actually 150%.
Or 150% or any percentage. It happened because global financial market froze as a consequence of whatever happened in the Lehman Brothers episode. Do we see that happening again? No. Do we see anything similar to that happening again? No. Because in our markets, what has happened in the past, people draw lessons from it and make sure same thing doesn't happen.
Yeah.
So if something hits us, it would be another unknown rather than something which has happened in the past. So if it is an unknown, I won't know it either. But from what we see, we think we are at very good levels. There's a lot in the price. For 1 year, markets have gone nowhere. Earnings have moved up 8%. So if you see market as following earnings growth, we have a spring of 7-8% in the price. And you have got a GST cut, and you have got a income tax cut in the budget, and you've got repo rate cuts, and you will expect more going forward. Lots of stuff working for equities. Tailwinds are good and strong, and lot of these, lower taxation, lower cost of capital, all also points to higher discount rate. So we think if you look at an index and people say it is average, average is because sometimes it is higher, sometimes it is lower. Now, if your cost of capital is lower than average, then your valuations today should be higher than average, and we are not. So I do believe there is a lot in the price. There is a spring. As people start to feel more confident, one should expect markets to catch up to earnings rather than otherwise.
It's another vector of what indicates the bullish growth of Indian equity markets is the consistent flow of SIP money, right? The FPIs have taken money and put in money and come and gone out and all of that, right? One factor that's remained consistent, which has really helped keep the markets stable in longer periods of time is the SIP flow, right? It's as high as 29,000-30,000 last month. It's been consistently growing, improving, consistently above 25,000 for a while now. Do you think retail participation there is possibility for it to remain this consistent and grow at this consistent pace that it has in the last 5 years? Because that is what has kept us intact and solid against the FPI turbulence.
Very strongly, yes.
Okay.
So let me give you the flow of my thoughts. We say India is moving from a country of savers to a country of investors. And it's got very strong linkage with per capita. If your incomes are lower, what happens is your expenses are fixed. In India, we know it is child education, marriage, etc., health. You have to save. If rates go down, you save more. Okay, I think this will be familiar to a lot of people of my age and beyond. They saved more. As your per capitas increase and you get over this fixed expenses of life, is when you turn into an investor. You can take risk of losing a bit of money for better
as the surplus in your pocket goes up.
So in the past, once again, if you see, equity cult in India was confined to metros. And then as per capitas increased, it happened in the West first, maybe Maharashtra, Gujarat, Tamil Nadu, Karnataka is how you saw equity culture improving. Now the hinterland is seeing the same, and the same phenomenon is there. So very large part of new people into the market is from Bihar and Odisha. Now,
the uninitiated markets that have never really invested in equity earlier.
Because there they are seeing the same phenomenon, per capita is increasing. This journey has just started. We are 1/5 of a Malaysia, 1/3 of a Thailand in per capitas. If we think our per capitas grow to their levels, forget the West, over the next 10 years, inflation stays at 3-4%. Lot of that surplus one should expect would come in the market. So we say, and we have seen it in China, which is the other stuff that people can look at. In 2008, China was a recipient of FPI, FDI like everybody else. Today, it is the largest FPI globally.
Correct.
We may be whatever number of years behind them, but you put any number, we are starting to see what they saw. If you put 15 years behind, you have 14 more years at least of that growth.
Correct.
Other way of looking at it. So very, very positive. On continued domestic flows into the market, it shall happen. It's already happening in a manner that FPIs are losing relevance. That is what. Now, if you are looking at near term also, so you look at flows into the market that happened in August to January of last year, and there is a particular amount that happened, high particular amount that happened. Now we are getting positive, but it is lower than that level. Now, why I say 6-7 month period is if something happened for 6-7 months, it's not a one-off. Economy has grown, inflation is down, so there is net surplus. Wages have grown, inflation is down, there is net
Yes,
surplus.
yeah.
So though we are getting a positive flow, one can feel people are holding back. Yes, we are getting positive, but the potential of that positive flow is higher. And I think it's a function of sentiment. As that improves, you shall see more flows coming into the market. And that journey has just begun. It is a very long journey.
I agree to that. The reason I asked this question also, Prateek, is that all it takes for a retail investor to lose confidence is one bad cycle. And these are markets we are talking about. There will always be cycles. And we've seen that in the past, whenever there has been a minor correction or a slightly longer term time correction also, the investors tend to lose confidence. The numbers become stable, the growth dries out. Very surprising for maybe people like us who understand that the markets are, these are cycles and markets will come back. But do you really see that as a risk? Because volatility is an inherent nature of equity capital markets, right? So
one, if you look at flows,
yeah,
very large part of it is SIP.
yeah,
In many months, SIPs are more than the total net flows.
yeah,
And there is no better way of coming into the market
then SIP.
versus SIPs, right? Think of it, we all know we haven't reached the retail in the country, but somehow as a population, we are doing the right thing. That gives me goosebumps. As a population, while we know whatever we are saying and whatever everybody is saying has not reached everybody, yet as a population, we are doing the right thing. If you look at categories like mid and small, and everybody advises come into these categories through SIPs, you see SIPs happening. Well, when the markets were down in COVID, I don't remember seeing any balanced fund manager having expanded the equity holding percentage of the portfolio, because they are the only guys who can tweak the weightages. It was Indian retail who came at the bottom, which again tells you that something has changed. Now versus the past, when people came into the market for momentum, for getting rich quickly, see, some bit of that even now happens, will always happen, but
Majority of them
larger and
stayed
larger
back.
part of it is longer term money. And what is also happening is when markets undergo a phase like the one that you are suggesting, what gets stopped maybe is a lump sum. People will take a call, something is not performing, maybe take it out. And I have seen wealth guys also advise, when once you take out some money, very difficult for you to get it back again, because the reasons don't change so fast.
Yeah.
That money comes back as SIPs.
Possible.
Sir, aap SIP likh do.
Correct.
And that money comes back as SIP. Depends on the longevity of bad times. If the bad times are short, when we saw it in January was a strong month as well. But it continued in Feb. It started to see some impact. And now for 3-4 months, markets have been up from a Feb level. We are seeing some bit of it return, but not to the same intensity.
Correct.
So that is the manner of expecting. Don't see SIPs falling below 24,000-25,000 for a long while. So expect that to sustain. But yes, it shall also be cyclical, but a rising cyclical trend.
Rising cyclical.
Yeah.
What's your view on the recent surge in gold and silver? Because India is traditionally being when you say savings, India's savings, large majority of it, while real estate is one always, the evergreen asset class for Indians, but gold as well. Gold has been very preferred asset class for Indians, and suddenly a lot of talk about gold and even silver now. Do you see a lot of that SIP money moving towards other asset classes like gold, silver?
We get asked that question. One thing is, I don't want to hyphenate gold and silver. मैं बोलता हूँ India Pakistan मत बताओ. Silver is not a valuable metal. It is not a store of value. It is an industrial metal. It's got industrial usage. By that logic, gold has very little use. It is money. Let's not do gold and silver. Let's talk gold. Now, gold does or have been doing for a long while what a Bitcoin wants to do for the future. I think it has a use more physical than paper. See, I am old fashioned, okay?
More emotional also for Indians, actually.
Yeah. One, it is a ladies' thing. We wear nothing, but ladies carry. So the whole thought is, come bad times, this will save us, this will carry us through. That sentiment is very strong sentiment. You can't take it away.
Yeah.
One. Second, in some manner, if you are growing and you bought X amount last year, I'm not saying tolas or whatever amount last year, this year, you don't feel good unless you buy similar or more.
Yeah.
It kind of tells you, yeah, I have done well. Okay, so demand will remain. It is also a volatile commodity. It don't get spooked by the current price increase. It may sustain, may not. But some bit of gold, I think people should always have.
It's a good hedge asset class also.
कोई asset class नहीं है. If the building is on fire and you have to run away, this is something you can carry and go. इसलिए I keep saying, have physical. It is your last resort. Very old fashioned, but this is how I think. And the best thing is the men of the house don't look at it. Nobody knows.
Yeah, I agree.
Okay, very, very women thing. And when the bad times happen, it is the women of the house who carries the family through. One would remember the value of the stocks you may have in your demat, debt, etc. No guy I know of knows how much gold is there in the house.
Yeah, nobody would.
Nobody knows. And hence it stays safe. And hence it is useful when the bad times come. Yeah. And most people get bad times.
So another important vector, Prateek, of India's success in the capital markets has been the phenomena of mid and small caps. The emergence of mid and small cap post-COVID, right? That's largely what has driven the Indian equity markets to a very large extent. Now, do you really believe that this is an earnings leadership story for mid and small caps of India, or is it more of a liquidity-driven phenomena? Because this debate I've not been able to take sides on. There have been periods where you feel that it's a genuine earnings growth story, and there have been times where you feel that it's just liquidity pumping money into mid, small, even the micro caps, as they call it these days. That is what is bringing that surge in that in the prices. What do you think?
Think of it, addressing your question in a slightly different manner. Markets will close today. There will be something at, let's say, $100. Tomorrow they shall open. That something, chances of it opening at 100 is low. If you are feeling good on the market as a whole, let's say there is a sea of green across the world. There have been positive tweets on us on overnight. There's something positive that's happened for the stock. You expect it to open higher. There is no money change that has happened and it opens higher. So think of it, any day, the amount that gets sold or bought is same. So unless there is a desperate buyer or a desperate seller, which can cause sharp price move, for most other days, the settlement between buyers and sellers happen depending on the sentiment of the day.
Yeah.
If you are feeling positive, the same 100 rupee stock would be settled at 100 rupee 25 paisa. And if you are feeling bad, 99.75. The sentiment is very important. That's point one. Flows, liquidity can drive valuations for a brief period of time. I get that. But think of it, if it goes beyond range, supply will come from somewhere. If nowhere, promoters will come and sell. So short period of time it can happen, long period it doesn't happen. One. Two, large caps have become a legend in India for good reason. The reason is, for a long part of our investing history, large caps actually did the best in terms of earnings growth. Just hold a simple belief, markets follow earnings growth. Okay. Now, a large part of our investing history happened after 91, after we pledged gold, after we gave away a degree of freedom to the IMF. Because we had to borrow under duress, etc., and had to open the economy. Now think of it, a brand is large cap. Let's say autos are the biggest part of manufacturing in the country. All the brands are large cap. Their ancillaries are mid and small.
Mid and small cap.
Okay, as the import duties were coming down, first we celebrated saying more affordability, consumer benefits, etc. But over time, we couldn't do a great job at manufacturing. It got decimated by Chinese. They did it very well. So you saw a lot of stress in mid and small. Go to a Calcutta, the region around Calcutta, which was all engineering, decimated. Things changed. So up to 2007-8, you saw large, there's a chart that we keep seeing, large to 25% earnings growth, mid to 25.1, hardly any difference. So large is good. In the next period, 8 to 20, 21, actually large did 5, mid did 4, small did 3. So if you follow, markets follow earnings growth, large did the best. Things changed from bottom of COVID. So I gave you this example of ancillaries, etc., because from bottom of COVID, for the first time, we got this thought of China plus one.
Exporting.
The world understood you can't put all eggs in one market, geopolitics, etc., put aside. Because when supply chains break, well, you still need your stuff, you can't get it out. So every country decided they need to do more. And for stuff they don't want to do, maybe have a second source. That gave every country the leeway to do more internally.
Yeah.
We see this is reverse globalization that started. WTO, nobody talks of it anymore. The biggest driver of globalization, the US, now understands it hurt them. And in the whole thing of make US great again, they are increasing trade barriers.
Yeah.
Well, this was what we were saying all the while. So versus pre 2020, you have to prove injury, substance, etc., for giving protection to the domestic industry, and it could take ages. Now it happens very quickly. So this is a time when manufacturing in India is blossoming. To think of it, and you started the conversation saying alpha, you need growth. Market follows earnings growth. Alpha is returns higher than large cap index, let's say. Now, if you think markets follow earnings growth and you want to spot spaces which can offer significantly higher growth than, let's say, a large cap index for a multiple number of years, not 1 year, then such spaces in the past occurred in software. Small, new, grew 100% for 8-10 years. Anybody who was there generated huge alpha. Other such space that happened, so software Indians got, private sector banks Indians missed. Again, small, grew 2x, 3x economy, index growth, PSU bank growth, for many years delivered huge alpha. In the same manner, if you come to the present, this is the first time that you are seeing several spaces emerge which are doing what a software or a private sector bank did in that period.
Yeah.
EVs, we hadn't heard of it 6-7 years back, right?
Defense manufacturing.
Defense manufacturing. So earlier people celebrated lower defense expense as a part of GDP. Now thoughts have changed. Renewables, people had not heard of.
Yeah.
New tech, that consumer tech, fintech that is happening, companies weren't there 7-8 years back.
Yeah.
And come to think of it, there was just one hospital of any size listed. If you wanted to buy luxury, nothing. And we just discussed the economy moving towards capital markets versus savings.
Yeah.
So those are very broad trends, very strong trends, which have kind of coincided with the bottom of COVID. And there is another behavioral thing that has happened. See, in the past, we were a capital constraint economy. If I go back to early 2000s, there was actually a debate saying ki we want to build infrastructure, where is the money? How can you even invite a private sector to do infrastructure when the equity capital that they have is not there?
Correct.
Okay, and this concept of pin equity, etc., started and all of that. Now, things have changed materially. So when you don't have money, you keep sweating the same asset over and over. You resist change. पैसे नहीं है. How do you invest for change? So the same old plant you keep growing for as long as possible. Now you see the change. You want to embrace change. And in some ways want to lead change. So as newer spaces, this is what you need for newer spaces to emerge. Older spaces to get disrupted. When this happens, it becomes a great time for alpha. Now, since many of these spaces are young, the top 2 companies of these spaces may be mid and small.
Yeah, at this point.
At this point in time. So the thing is, look at growth, sustained growth, long period growth, not size. I keep doing this, look at the lifespan of a guy. Every guy, first 2-3 years will fall more, a lot of damage can happen, etc. But once you get into your teens, for next 20-30 years, you will grow very strongly, hardly anything happens, and then over 55, over 60, another phase starts. As an economy, as a business, hunt for places which are hitting teens.
In its prime. About to hit prime.
Yes. Versus places who had a great past and hence may be large, but equate them to people.
So you're saying don't look at size, market
look at
cap.
size.
Look
Yes.
at exactly
Growth.
the fundamental
growth, sustained growth. That alone makes you money in excess of the index, is the recipe for alpha to my mind. We have been practicing it. We have been speaking of it. Theory says this only. In the equation, PE की जो equation होती है, उसमें growth होती है और discount rate. There are only 2 things which happen. Size comes nowhere. Maybe you can say that larger size is less volatile, less risky, so discount rate that you apply is lower. That's all. Otherwise, it is growth.
So for an investor, Prateek, let's say if FPI was an indicator of where the capital is getting allocated, manufacturing, capital goods are some of the sectors. I'm just deep diving into sectors that are likely to generate that alpha that you just spoke about, right? So manufacturing, capital goods, there's a lot of interest in renewable energy in India. We saw a few NFOs that really took off, showed the interest that is being generated there. So a lot of FPI money is coming into these sectors on the manufacturing side. A lot of the FPI money is being pulled out of sectors like, let's say, IT, pharma in India. So for an investor, are these the right indicators to look at which are the sectors, which we need to really focus on as far as our investments are concerned? Or you think these need not necessarily be the indicators in terms of where the growth lies?
No, so not good to track FPIs.
You earlier mentioned FPIs are becoming irrelevant in the scheme of things.
Really believe that.
Okay.
To a very large part of the FPIs don't come to the country for the reasons you and me invest. So we invest because we think country grows faster. There are spaces which will grow faster. Faster growth will make that space more valuable and we can make money. Think of it, very large part of FPIs may be coming to India for the yields. They may be buying cash, selling futures. Okay, competing versus, let's say, a 10-year US treasury. It is riskless, as riskless as it gets. They're doing very different stuff. Okay, there is another kind, you call it hedge funds, who are buying what they like, who are selling what they don't like, and put a leverage on top of it. We say the third one is an alpha seeker. The big guys, the pension funds, sovereigns, etc., who give managers here money for their alphas, short an MSCI abroad, MSCI India abroad, just seeking out alpha. The fourth variety, the large one, is an emerging market FPI who is competing on relative valuations. They may be coming to India because China has become now 40%, has done 40% relative more than us over last 1 year. And they may have gone out of India because something else was looking cheap when they did. For Indians who have to focus on majorly what is available in India, very small part can be taken out through LRH and all of that abroad. I think one should be focused on what's happening right in this country, hold a belief as to what is the way for making money. One is growth that we described, the other could be value. We do that less, we are growth investors. If you are wanting growth, seek long period growth, not 1 period growth. Long period growth would be available in younger spaces, spaces which have policy tailwinds, spaces which the globe is talking about, newer trends. I think increasingly, if one focuses there, you will get growth which is significantly over large cap indices. Of course, you have to double check for valuations in those spaces. And check for, a lot of new spaces are winner take all, who is winning. So, and move monies accordingly.
So I think FPI is not necessarily the very important indicator.
FPIs are...
because a lot of our investors do track. I mean, they track FPI money going out? Should I liquidate? Typical queries and questions from customers that there's so much of FPI money moved
So,
out.
yeah.
Should we sit on cash? Should we rebalance? All of that.
No, so in some manner, it has gotten more difficult than before. Because just think of it, you are an FPI is what, a fund abroad, right?
Correct.
Which gets in, let's say, pension money, sovereign money, or retail money abroad, or HNI money abroad. Think of it today. Can you go to an investor in Europe or a US saying, I want an emerging market fund, please put in money? US doesn't seem to be liking a Brazil or an India or a China or a Russia. Where is the story?
True.
तो आप तो पैसे नहीं ला सकते उसके अंदर. Typically, if you want outperformance, you look at money flow continuously being there. Today, it is not there. At best, it is a leaking bucket. So tracking that doesn't make sense. Now, I said if that same leaking bucket, thinks China is cheaper, it will go there. If it thinks India is better, it will come here.
back.
So idea is to keep positioning monies while they are going away, because when they choose to come here, you will get a one large month.
Yeah.
So that has become, if you track FPI, that's become the game.
Correct. Yeah. Absolutely. Totally.
But best don't track them.
Right. Another argument that comes from foreign investors is that India continues to be largely a consumption story and not necessarily a capex, manufacture and export story, which is what they feel is essential for it to become 7 trillion, 10 trillion economy that we keep talking about. How much do you subscribe to that thought?
I think if we look at various models which have done it before us, that thought is right. So we got the ASEAN countries, leapfrog by investing, by exporting. You saw China do it. And the whole world also said that this is not balanced. When somebody else sneezes, you will get a bigger cut. If in that manner you see India developing, we have been very balanced. The way we are able to look at global headwinds in the present, our behavior would have been very different had we been a very joined economy to globe, which we are not. In some sense, we are very balanced. No one sector very large in the economy. Multiple newer things happening. Yes, we could have done a few things better, always true. We do feel in manufacturing we could have done much, 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 much better. But that's also the opportunity of the day.
Correct.
So for anybody who is looking at us from the outside, I would say don't prescribe. We are doing our bit. There is no other country of any size who has grown at 6 to 7 real, 9 to 10 nominal for a long period of time and shall continue to do it for a long period of time, where so many newer spaces are emerging and becoming investable. Think of India as a economy which offers very long period growth across spaces. We are the last economy to be offering that. So I'll give you an example. In the West, where the economies grow between 2 to 3.5%, necessarily you are a value investor. Something falls, lower P, you buy, thinking it comes back to average Ps and so on. Economies try to induce growth by making regulatory changes. So I read one long time back, there is a regulation change that a lift should have so many new things in it. So the lift in the West were not safe, perfectly safe. It was just that, if you put in so many new things, there will be demand creation and there will be growth. So very different from us. Here we are an aspirational society where very aspirational, very capable, very intelligent people who in the context of the world have nothing. So the longevity of growth that India offers, nobody else does. Think of it in China, they have started to degrow cement and steel. These two businesses also in this country are growth business. Lower growth, but growth business. Think of India as your last sustained growth destination. You like consumption, we consume. You like manufacturing, infrastructure, we do that as well. In long periods, so 2000 to 2008 was a capex infra-driven growth. Consumption took the backseat. 8 to 20 was a consumption-driven growth. I think from 20 onwards, it's been again capex-driven growth. Other part is also growing. It's just that capex part is growing a tad faster.
So, see, we start the conversation saying India is a alpha seekers market, right? For if the economy is supposed to be reaching 10 trillion by 2030 is what we
थोड़ा ज़्यादा है, but ठीक है.
what we talk about. But for us to sustain or even grow market cap to GDP ratio at that GDP levels of, let's say, 10 trillion, do you think it's practically possible to do that from a market cap perspective without the significant growth in passive funds, right? Where investors just coming and allocating. Some of the more developed markets, the passive fund to active fund ratio is 3:1. Practically 3 times more money is lying in passive funds, right? That's not the case in India. The argument that we hear is that India is a growth seekers market, alpha seekers market, and that's why they put out dollar on the table to see who gives better returns. But at what stage do you think it could be a long time from here where passive funds will have a very meaningful 12 lakh crores is what I hear last the AUM in passive funds is, but still significantly lower than the overall pool of managed money, right, in India. What stage do you think that will really the inflection point for passive fund growth in India?
We really believe in passives.
Okay.
We run one of the largest pool of passive money in the Indian AMC industry, largest suite of products, etc. We think the way it's not that people won't be delivering alpha here, and I'll explain alpha, but the way in which funds are being sold to clients results in zero alpha for them, negative outcomes for them.
Fund would have done well, but clients not made money.
Because two reasons. One, in India, there is this huge quest for consistency and disjointed portfolios. So if you're consistent, you buy one fund which is positioned, let's say, on one side of the index, but close to the index, and disjointed, matlab the next fund that you are buying is on the other side of the index. You average index, you're paying active management fees, you're below the index overall. Second thing that you see in the country is every investor holding 10 plus funds, and the funds are now getting longer and longer.
And if you just break it into underlying, maybe 100 plus.
Yes, so you end up holding the market through one guy or the other. So, and now investors have started to point that out, saying ki, maybe some fund is doing well in one time, somebody else, but I am not making more money than the market. And that is something which is really driving passivization. So we say versus doing it this way, if you have to get index returns, passives are a better way of doing it, lower cost, you do it. For active management, hence we say we do it. Look at focused high conviction constructs. Everything that you see in our house will be that way. And look at style diversification rather than increasing number of funds and de facto looking at manager diversification. So we see, let's say, ourselves as a pure play, high growth in earnings focused house. We say pair us with the best of value, 125 names, job done. And when value works, the other guy will work. When growth works, we must work. And if both are best in the craft, your chances of having alpha increases. So I believe, if we keep doing stuff the old way, over diversification is a net outcome of that, and that will drive passivization. We have to rethink. Absolutely. And we have been very vocal about it. Now, we do think it is time for alpha. वो क्या होता है, this whole thought of passives and all the proof that you get comes from economies where the growth quotient is very low. So there, ultimately markets follow earnings growth. If the economy is growing at X, market shall grow something similar over time. And then there is cost of managing money, and then there are errors and omissions. All of that, 3.5% cost, 1.5% errors, omissions, another 1%, you are index. But if you see the higher growth spaces in the same economy, the high growth guys who are doing newer tech companies would be probably generating substantial alpha with all the volatility in the interim. So alpha occurs in, at least my belief, I believe markets follow earnings growth in high growth spaces for this reason. Because in lower growth spaces, your cost and cost of managing money and errors and omissions make you index very
Yeah.
quickly.
You mentioned very interesting point that some bit of this is also got to do with how wealth managers allocate client portfolios, right? And I agree to that. I wouldn't disagree. But the other side of that same coin is that in the recent past, not many fund managers, let me put it a little mildly, a lot of fund managers have not been able to even beat the benchmark. Forget about generating alpha and then, retracting it. So that also has resulted in, the investors, the customers really questioning that, shouldn't I just, sit in passive funds and ETFs rather than, trusting a fund manager, and then, not really. So that to my mind is also significant. While I agree to your first point that there is the way it's managed is also kind of not very elegant. So how do you think that needs to really balance out? Because I personally feel that you can't have an overwhelming number of funds or fund managers in a period not generating any alpha, right? So how does that?
So times change. So when I say alpha, if you do an index very properly, alpha generation is actually very difficult. But then one should be able to invest in that index. A perfectly done index. So suppose a fund manager constructs saying, 35% large, 15% mid, and rest of it small. And you do an index which completely is true to this style, and the manager continues here, that 15% mid stays 15, it doesn't expand, and so on. Very difficult to beat the index. Okay. The problem is managers change where they have the flexibility, and that is a source of alpha done well. Now, to simplify the question, just hold the thought. Markets follow earnings growth, right? Most people seek alpha versus the large cap index. यानी two indices people remember. पहले सेंसेक्स ज़्यादा था, अभी निफ्टी ज़्यादा है. People don't really remember the other indices. Now, in periods when the large caps deliver the best earnings growth, as it happened between 8 and 20, the number of people, number of managers who can generate alpha reduces significantly. So in this period, I used to count, there were just 7 houses which delivered alpha. And those tended to be highest quality focused guys, because in that period, look at a consumer index, it did a 12% earnings growth versus the large cap which did 5 and the others did even lower. Stuff like pharmaceuticals, 2-3 financials, some 17, 18 stocks, which delivered very high earnings growth quotient in a sustained manner over this period. Out of an industry which is very large. Okay, now come to the present, look at the data from 20 till now. You will find number of people who are generating alpha having gone up substantially.
Okay.
Because the natural tendency of managers is start from large but go to mid and small. In a period like 8 to 20, when mid and small did not have earnings tailwind, it was like one good period and then followed by one bad period. It was killing managers. Now, when the same space continues to show growth, more managers are able to generate alpha. So while overall I get it, still that number is not like what you saw in the 90s. That percentage overall may have gone down, but from 2020 onwards versus 2008 to 20, the percentage has definitely gone up massively.
So, Prateek, we spoke about the wealth manager's role to play. We spoke about the fund manager's role to play. Now, let's talk about, and if you were to say that each one of them have equal role to play, the investor himself has a very important role to play here, right? And I've been a very strong proponent of changing investor behavior, right? When you say changing investor behavior, for example, I'll give you one small example which I feel very strongly about, and whenever I've spoken to people like you and you as well in the past, my question to you, people like you, has been that how does one change investor behavior in terms of making investment decisions basis past performance? And my favorite example to give is you do not buy let's say an Infosys stock because it has delivered great returns in the past, right? You don't do that. You buy, you invest in Infosys because it is likely to do very well going forward, right? And probably a mutual fund or an AIF or any product for that matter is nothing but combination of 30, 40 such stock ideas. And one should look at the same investing principle when investing in a fund, which one does for investing in a stock. And which is where it completely changes dramatically. Everybody starts looking at, what this fund has given great returns in the past, and that becomes the primary driver, decision making driver when people choose. And that is what has to large extent caused a lot of disappointment when people look at their portfolios not performing, right? And how does one change that behavior? I know it's a collective responsibility, and we try to do our bit. I strongly push this behavioral change in our people and through them in our customers. But what can we do more to bring that change?
So this is very difficult for a variety of reasons. Because in many ways, our distribution channels are built for averages, and investors, fund managers are rewarded to be close to averages. Because, one thing very strange that I see in every conversation is this quest of consistency. It's a wrong quest, because if you're looking at somebody who has done very well, he has not been consistent, because in our line consistency is close to index. If somebody has given outsized numbers, he has not been close to index. होता क्या है कि you spot that guy, you give him money, and you keep expecting him to give same.
Stay there.
Yeah, which doesn't happen, because we spoke of two styles. Styles change, flavor of the market changes, etc.
Market cycles. You can't be your strategy can't be built for all market cycles.
Exactly. So, one, if you want better outcomes, we have to think differently, educate investors differently. Why I think very difficult, because investors themselves behave in a manner that results in averages. Agar something doesn't do well for some time, they get hassled, come and hassle the intermediary. Now think of it, most investors are small. Not a politically correct thing to say, but most investors are small.
Yeah.
If they come back to the advisors and say this has not worked and takes away 30 minutes of time, it's a loss-making proposition.
Yeah.
Best to give them passives, which is average. To cut through this, one has to not look at stocks that resulted in a manager doing very well. Look at style. And if you are pitching to a client, pitch that this manager is great at this style, and if you have an overlay of processes, even better. So you will stay true to the style, and this manager is great at, let's say, value style of investing. Now, yes, the client wants more consistent performance. So if you want it, then have both. If you think it is time for growth, have more of growth. If you think it's time for value, have more of value. And this more can be tweaked with monthly inflows.
Yeah.
It really doesn't need to be selling one in favor of the other. To understand the investor, so in this, you are actually telling him that both won't do well. Today, the first anxiety of a guy who is pitching is, I'm pitching you all stuff which shall do. Has done well is to show that will do well.
Yeah.
Is where the problem happens. Exactly what you are saying. Here, you are actually saying, sir, madam, both won't do well. That gives you a power. But both of them are best in their craft. Okay, we think it is time for growth basis these four things, or we think it is time for value, and hence we are proposing more of one versus the other. Outcomes can be very different. You become a consultant to the end investor, expectation settings are very different. You actually reward people who are courageous enough to run large tracking error funds. In the quest of consistency, people are being rewarded to be close to the index. Lambe fund, best done by passives, no need for active managers there. So, right selling, differentiated selling, preparing investors, and which is the difficult part. For total outcomes, not outcome of each constituent, is the way out, which is what, at least in all of our public meetings, we keep talking of. Is one solution. I think others would have different solutions.
Yeah. No, we've been at it for a while now, trying to solve this, but like you said, it's a very difficult.
It's a very difficult
Very
one.
difficult.
Yeah.
Yeah. So, Prateek, you've seen market cycles. You were investment manager right from, I think, much before dot-com boom around that time. Then the financial crisis of 2007-8, and then COVID. All of these cycles, had a common outcome where markets corrected significantly. Do these kind of cycles really change the fundamental principle, the fundamental philosophy of how you manage funds? Is there like a common theme of learning that comes out from these kind of events? If yes, then how have you done it? Because see, the biggest worry in an investor's mind is an event like these. They don't happen very often, but is there something that you think of it as a common learning from these kind of events?
I think one good learning is one should stick to asset allocations, which should be adhered to. One asset class does very well, move money into the other while keeping on riding the one which is doing well is one way to do it. The other thing is to keep coming into a volatile asset class like equities through SIPs. What I also now say is dips are good. So if one believes India is a structurally growing economy for several years, then any dip that you get on the way is godsend. That should be used to do more than SIPs in that period. Is the way out. Otherwise, very little. One has to stay the course. Suppose one has come in completely. Mostly one should sit through the crisis.
See through the crisis, basically, because I think
it-
all of these
it-
crises,
it
one
blows-
thing in common is that
it blows over.
they may have taken
Yes.
different time periods to recover, but
it-
all of them have recovered, and how?
The trouble with crises is that no two crises are same.
Similar.
In our markets, I keep saying there are a huge bunch of people, some of the best globally, who look at a crisis, see the reasons, make sure that it doesn't recur again.
Yeah.
So, and hence I believe looking at the past, saying कि उस समय ऐसा हुआ था, again it is going to happen, won't happen.
Not half.
It basically means
Because the regulators also are looking at it.
Yeah, so 2007 happened not for valuations or anything, but because in the US, the broker was the counterparty.
Yeah.
I am a Lehman, you are one client, she is another client, and Lehman goes. You don't know each other. In India, it doesn't happen. We have an exchange in between.
Correct. Yeah.
So people have learned. So now in the West also, people don't do more of such trades.
Yeah.
So every crisis has learnings, and the world tries to make sure it doesn't happen again. And it doesn't happen again. So is my belief. So next time we will have a crisis. We will always have a crisis. वो ब्रह्मा विष्णु महेश समझ के रखते हैं, कुछ ना कुछ तो होगा. But looking at the past won't tell you what's going to happen next.
It's more of a unknown. Every crisis is actually an unknown when you're in the crisis.
So what do we do? Well, look at more spaces that are close to you. So more domestic than offshore. What kills you is leverage. Don't have too much of leverage.
Yeah.
What really can go wrong is commodities. So if the world goes in a crisis, somehow the commodities prices
react
go
the
down.
fastest. Yeah.
So if you look at our constructs, very little leverage, if any, no commodities, very little of offshore, more domestic is how you build solidity in the portfolio.
Very interesting guardrails. That.
Last thing is teams. See, in the end, while a business may have tailwinds, good guy, good management team will have better outcomes versus not so good. So in the end, it becomes backing a guy, backing a team rather than anybody and everybody.
Yeah.
And we have seen very good examples of that.
Right.
Young management teams, fire in the belly, can result in far better outcomes versus not.
Yeah.
So that is another focus that one should see how much fire the top management has to grow.
Interesting guardrails these, Prateek. So in the interest of time, what we can do is the rest of the questions we can do in a slightly fun light-hearted, rapid-fire method rather than a traditional method of conversational method. So are you up for it? Yeah. So I have a few questions for you. Very simple, straightforward ones. Shoot back with short, crisp answers. I think one stock or sector you wish you had spotted much earlier in life. A regret that ये कर लिया होता तो. I know a lot of people, having such regrets. So you have any?
Why do you think I remember a software at a private sector bank? So software I was very late, and there is a reason for it. Private sector bank, we missed.
Yeah.
And again, when you look back, there are reasons for it, but we missed. So yeah.
Okay. The most underrated skill, according to you, for a successful fund manager, that nobody really appreciates that skill, but you think it's very important.
Time to sell.
Time to sell.
Very important.
I agree. You'll get 10 advices on what to buy, when to buy, but time to sell.
Nobody advises.
Nobody advises. I agree. A market indicator you quietly track that most people ignore, if you can spill out the secret here.
The trick is not to track too many. Track very few that matters. There are just too many indicators. And secret indicators won't matter because people won't be following it. This is a crowd behavior.
Had it been that good, then वो secret नहीं होता.
Secret नहीं होता.
So if you had to invest your entire net worth, again hypothetical, in only one asset class or next year, what would you choose?
Easy one for an equity guy. Yeah. It has always been equity. Mostly it will always be equity.
Okay. The boldest investment call you ever made, which was proven right, which very contrarian, nobody believed it.
Actually, when somebody else sees it, it may appear bold. But when me or my managers do it, it may not be bold. I'll give you an example.
Yeah.
We spoke of growth spaces, betting on fire in the belly managers, promoters, etc., and putting money. So there is a logic to it, right? So we went to new tech with that logic. Somebody outside may think that's a bold thing. For us, this is natural.
This is natural.
With somebody else's money in our business, you don't take bold calls. You go where there is conviction. It is natural to us. Yeah. Is the difference.
Maybe in hindsight to everybody it looks natural, but at that point in time it may look bold from outside.
But आप bold call कैसे लोगे? We don't do 0.5%, 1%. We do minimum 2.5%, 2 more. So unless there is conviction, unless there is belief, unless you really believe in it, you won't go there in that intensity.
Interesting. Toughest question an investor has ever asked you, which you found difficult to answer, defend.
So I have an investor. It's a real life. He is invested in 2 of our funds. Incidentally, both were doing well. But one was doing better than the other. Why is this not doing better than me?
So that is, that is a customer for you, right?
So yeah, you get those questions. I'm sure there are a lot of notions that people have about how a fund management house works. Some bit of it right, some bit of it not right, and it can get very difficult. But that is life.
Yeah, the customer is always right.
Yeah.
So if you have to describe Indian markets in one phase for foreign investors, I know you find them inconsequential now, but what would you say if you were to just describe
last growth story? Growth. Yeah.
What's that one financial habit you think every young professional in India should start, like today, now?
No, so there is a change between our generation and this. We spend less than what we earned. We see youngsters spending more than what they earn. I really believe they should be spending less than what they earn. वो हमारे ज़माने में होता था चादर पैर उतना ही फैलाओ जितनी चादर है.
पहली नौकरी लगते ही वो 1.5 लाख का स्मार्टफोन ले लेता है.
हाँ, वो they borrow to spend for the present. We save for the future. Maybe don't do it to our extent, but at least stick in the amounts you are earning is one big advice.
Okay. A contrarian view at this point in time in current market, Prateek, a contrarian view you would hold, which many around you don't agree. Is there any?
A lot. So if you see our constructs, we have practically zero overlaps with others. So to others, everything that we do would be seemingly contrarian. The method in madness is we are in spaces where we see very disproportionate amount of growth sustaining for longer and supported by our belief that markets follow earnings growth. Most other guys haven't done it with the intensity that we have done. And of course, so we think there is spring in the market which needs to be realized. We really think there is money to be made over the next 12 months, while the last 12 haven't made money.
Great. Phenomenal. I think, Prateek, talking to you, conversations with you are always
Thank you.
interesting. We can go on like this for a couple of more hours, but in the interest of time, I think that's about it for today.
Thank you.
Thank you
Nice
so much
speaking.
for taking time out and having this conversation with me.
Thank
And
you.
I hope you enjoyed it as much
No,
as
no, I enjoyed it. I hope your viewers enjoy it. Thank you so much.
Thanks. So that was Prateek Agrawal joining us on First Talk. I hope you enjoyed this conversation as much as I did. Thank you.